enabled.
Kotak Mutual Fund presents Investmentor in association with Network 18.
Hello and welcome to Investmentor, presented to you by Kotak Mahindra Mutual Fund in association with Network 18. Now, this is an investor education and awareness initiative by Kotak Mahindra Mutual Fund, and I'm Sonia Shenoy. On today's show, we have a very interesting topic. We discuss gold as an asset class. Now, a lot of us, our parents, our mothers, grandmothers have purchased gold in the past for luxury, for leisure, for weddings. But as an asset class, how have the returns been in the past, and is it a lucrative investment for the future? We have one lady and one gentleman joining us on the panel today. We have Manish Mehta, the Joint President and National Head Sales, Digital Business and Marketing at Kotak Mahindra Asset Management Company, and Lakshmi Iyer, President and Chief Investment Officer, Debt and Head Products, Kotak Mahindra Asset Management Company, joining us now. Thank you to both of you for being with us. Now, this is a common dilemma. Manish, I want to start with you. How much gold should one own in their portfolio? And at a time when other asset classes like equities are doing so well, does it even make sense for someone to have gold as a large chunk of their portfolio?
So, Sonia, I think over the last couple of years, gold as an asset class has started to emerge in the mindsets of a lot of investors. As you mentioned in your opening remarks that, gold historically has always been for jewelry purposes or for luxury purposes. But a lot of investors have started looking at that in their portfolio as an alternate investment. As you're aware that, gold works as a perfect hedge against inflation. And it is advised that, at least about 5 to 10% of your investment portfolio can be looked at asset classes like gold as an investment option.
Lakshmi, come in on this because, traditionally we've seen our mothers, grandmothers buy gold, wear gold jewelry. And earlier it used to be regarded as a very big status symbol to have a lot of gold, and perhaps more for South Indians, like you and me. But now not so much, right? People have gotten a bit more savvy. You tell us, from an investor standpoint, how should one approach gold?
Clearly gold has that magnetic pulling. Of course, for South Indians, no doubt about it. And I hail from Kerala, which is the hub for gold. There is barely a wedding or there is barely an occasion where you see people not wearing or consuming gold. But the reality of life is that it has various other utilities apart from being just an aesthetic instrument or an ornament which can be donned. And as an investor, I think it is very imperative to have multi-asset classes as part of your portfolio. So if you are an investor who invests in equities, if you are an investor who invests in fixed income, so basically if you are a financial asset class investor, it is very imperative that you have gold in your portfolio and treat it pretty much similar to a term cover or a term insurance. It is very incidental that gold makes money for you, but it's the financial asset class that actually pulls up your entire portfolio and your returns over the tenor of your investment stint. So I think that's the way the investor mindset has been morphing in the past decade or so. And I think that is exactly the way investors should do this asset class.
But Lakshmi, just to follow up there, you were talking about how weddings in Kerala have only gold as the major part of the event. I remember when I got married, I was also wearing quite a bit of gold. And now when I think back, if I had, rather than investing in physical gold, if I had just put that in perhaps digital gold, gold ETFs, gold bonds, maybe I would have made a lot more money. I don't know. You correct me if I'm wrong. Is the better way to approach gold investing in digital gold, or do you think physical gold is still the way to go?
See, my mom will see this. She will hate me for making this statement, but I don't have any doubts in my mind that digital ownership of gold is the way to own gold. And why I say that is the most important reason being that as a retail investor, I get access to wholesale prices of gold. I think that's very, very important. There is no padding of costs and all of those things which you otherwise incur when you buy gold from a jeweler or from any other modes in physical gold. Storage, of course, we all know this is paper gold. So I don't really need to worry about where do I hide it, where do I store it, where do I keep it, and more importantly, insecure about what will happen to it when I'm not around or when I'm on vacation. And lastly, what about the liquidity? I think a physical asset class, whether it's real estate or gold, typically tends to be illiquid and has huge impact cost when you are when you make an entry or an exit, specifically an exit, and with huge breakages and costs, etc. Here, you are having seamless entry and exit when you are owning different digital modes of gold, and whether it's ETF or sovereign gold bonds, etc. So I have no doubt in my mind that form of ownership is the digital mode of gold.
Manish, comment on this. There are many options within digital gold itself, right? As we were talking, there are ETFs, there are sovereign gold bonds, there's gold in the digital form itself. Can you explain to us what is the difference and which is the form of digital gold that you would advise investors to get into?
Sure. So from the mutual fund perspective or a mutual fund arena, we do have like products on the gold. So one you have, as Lakshmi mentioned, the ETF, which basically mirrors and tracks the price of gold, which is very simple to buy and sell, just like how you would buy an ETF on the exchange, where the underlying assets that you own is ultimately the gold. The second option, obviously, is like basically many mutual funds also have gold funds, where you subscribe to that particular mutual fund scheme, which underline invests in the ETFs of gold. So you have that as an option. Globally and in India, in few cases, there are even mutual fund schemes where the underlying investments are made in gold manufacturing companies. So if you also get an opportunity to take exposure not only to gold as an asset class, but also in companies which are basically into manufacturing of gold. So that's another option available. Besides that, you have, Lakshmi mentioned, the sovereign gold bond scheme of the government, which is like, where one can look at investing in gold, which one could purchase through like the various bank counters. So these are the various options which an investor has in case if he's looking at allocating some money to gold as an asset class.
No, you've given us the various options, Manish, but my question to you was, what's the prudent way to invest, to put in some fresh money to work in digital gold?
I would personally look at the basically the gold ETF, because as Lakshmi mentioned, it's extremely seamless. It's very easy to buy and sell. It's a true representative of the price of gold on that particular day. You can buy it online through platforms and through various mutual funds and through the broker also. So I think that's a very simple way of sort of transacting in both from investment point of view or from a redemption point of view, as well as a very simple way of holding it, because it's a paper representative of the underlying gold that you own in your investments.
Lakshmi, who should invest in gold? That's a big question, right? So if you were to just kind of explain to us, which is the kind of investor that should be investing in gold at the moment?
Any investor who is having access or who is making investments in financial asset classes, irrespective of the genre, irrespective of the age, ought to have some investments in gold. Now, why do you do that? Because gold as a store of value, as a hedge of whatever way, it usually is the last person standing. Now, what do I mean by last person standing? Gold is a friend of uncertainty. Gold is a friend of upheavals. Gold is a friend of geopolitical situations and multiple such things or war-like scenarios. So gold tends to be a friend for all such situations. Now, you can't plan these situations or you can't plan your investments for these situations because these are usually unknown events. And therefore, having a 5 to 10 or 15%, depending on what your investments in financial portfolio is, if you're higher tilted towards equities, maybe closer to 10% would be a fair number. Globally, there is no rule of the thumb as to how much allocation is an appropriate one. But typically, we have seen that having, as an early investor, having about 5% and as your stakes in the markets go up, increasing it towards 10 to 15% is not a bad idea at all, given that incrementally markets are getting interconnected and the uncertainty level seems to be increasing. So when there's a risk off, as we call it, risk off sentiment, when risk assets like equities start getting a little bit wobbly, it's at that point in time gold acts as a shahenshah on your portfolio. So I think every investor should do it, gold investment.
I like that. Gold acts as a shahenshah. Perhaps it's a good hedge as well, right? When equities are looking a bit risky. I do want to talk about the tax implications of investing in gold, physical versus digital, as well as a little more in detail about sovereign gold bonds as well as gold ETFs. But I'll do that on the other side of the break. So do stay tuned in. We'll be back with Investmentor, presented to you by Kotak Mahindra Mutual Fund in just moments from now. Stay tuned.
Kotak Mutual Fund presents Investmentor in association with Network 18. Kotak Mutual Fund presents Investmentor in association with Network 18.
Welcome back to Investmentor, presented to you by Kotak Mahindra Mutual Fund in association with Network 18. This is an investor education and awareness initiative by Kotak Mahindra Mutual Fund, and I'm Sonia Shenoy. We've been talking about the different kinds of investments that one can make in gold. We've been investing in gold as a physical asset for very, very long, but now things have changed. There is digital gold, there are gold ETFs, there are sovereign gold bonds. There's so much to choose from, which are safer, easier to buy, and easier to kind of hold. We have been in conversation with Lakshmi Iyer and Manish from Kotak Mahindra Mutual Fund. From a taxation angle, Manish, take us through the difference. What is the difference if I buy physical gold versus digital gold? And within digital gold as well, is there any change in taxation between ETFs and gold bonds?
Yeah. So as far as on the ETFs is concerned, because it's an exchange traded fund, I think the taxation as far as gold ETF is concerned is similar to the fixed income taxation, which is 20% long-term capital gains after 3 years, and with indexation. As far as the sovereign gold bond is concerned, I think you get that benefit where I think there is no taxation on that particular investment, because government, probably RBI and government is also trying to encourage that more schemes so that people are veered towards more investing in sort of digital gold or these kind of products rather than actually holding physical gold. So those are the benefits and stops that the government is looking to offer. And ETF, it's the similar tax. It's about 20% long term, just like how you invest in fixed income securities.
Lakshmi, comment on this. What would your advice be from a taxation angle? How should one approach it?
I think more than the taxation, Sonia, one should clearly look at what is your end objective that you want to achieve. Because in the digital form of ownership of gold also, a sovereign gold bond comes with a longer tenor. It comes with an 8-year kind of a period, and there is an exit only from the 5th year onwards. So if you are willing to be okay with compromising on the liquidity element and sometimes a discount ab initio when you subscribe to SGBs, then obviously that is a much prudent alternative. But yes, if you believe that liquidity is of paramount importance, other things being constant, you get the indexation benefit as well, then you are better off doing a digital investment in gold through the ETF route. So I think that should be a key driving factor when you are making the allocations. And of course, the long-term capital gains tax kick in for gold ETFs after 3 years.
Manish, comment on this, because we generally or other experts generally recommend when to buy, but they seldom tell you when to sell. So if one buys gold for the long term, how long would you recommend one holds on to it? And what role does gold play in wealth creation for the longer term?
Yeah. So Sonia, just taking cue from what Lakshmi had to share. So ultimately it boils down to the principles of asset allocation. And typically, it's always recommended an ideal asset allocation between equities, fixed income, and alternates. And within alternates, obviously, gold plays a very important part of your portfolio. And ultimately, it's about the discipline that you need to remain in. If I was to just go back to March 2020, and when the pandemic hit and the equity markets were at its low, and there was uncertainty all around. For those 2-3 months, you saw a massive rally as far as gold was concerned. And if you had seen any kind of comparative analysis charts being put up in public media, it just showed that bar chart that where gold returns have been, stupendous, and equities being bad, and fixed income is somewhere in the middle. And if you had to see the same chart as of December 31st, 2020, that particular year, equity was right on the top and gold was somewhere, in the middle. So I think what the common mistakes at that point of time, and we also been seeing it, that suddenly there was a big spike in demand for gold ETFs. I think a lot of people were subscribing to that asset class, and people felt that, okay, that's, the next safe haven to be in. But at the end of the year, the picture was completely different. So I think it's, again, very, very important that one sticks to that principle of asset allocation, where equity will continue to play its important part in the portfolios over a period of time. Fixed income, maybe 1 year, maybe a little subdued, but the next year, fixed income comes back. And if you see asset class performances across various time periods, something or the other will always keep doing well. So, you have between equity, fixed income, and alternate, you have 3 to 4 balls that you're juggling in the air. In one particular, एक ball तो ऊपर हवे में रहेगा ही रहेगा. So it's important that you stick to your principle of asset allocation and time it to the time horizon that you have in mind. And I think overall the portfolio will play out well.
Okay, but the only problem is that people don't know these principles of asset allocation, right? That's why you and Lakshmi are here to guide them. Lakshmi, come in on this. I mean, if one buys gold now in digital form, either sovereign gold bonds or ETFs, how long do you recommend they hold on to it?
As long as you continue to hold equities, fixed income, and any other forms of deposits, PPF in your portfolio, if it's meant for 10 years, please hold gold for 10 years. If you're going to hold it for 15 years or 20 years, continue to hold gold. You can do a staggered investment if you believe that lump sum, because you might be doing systematic investment plan in equities. The way I look at it, Sonia, when you have allocations in your portfolio, both financial asset classes and physical asset classes, it has to be a combination of Brahma, Vishnu, and Mahesh. And the existence of all the three for the universe is important. Likewise, the existence of all the three in your portfolio is important. One can't say that this needs to be eliminated right now because this is getting overwhelmingly important. So Brahma is the overall equity allocation, Vishnu is your stability, fixed income, and Mahesh comes in when there is likely a potential of destruction and there is someone coming there to calm. So I think that's the combination, and therefore I don't see any reason to time exits unless you're a trader. Then it's a very different ball game. But otherwise, if you're an asset allocator, the reason for you to enter or exit in a very, very short span of time does not really arise.
Surya, if I can just come in here and flip a question around and ask you all, because at the beginning you all mentioned about, when you all got married, the amount of gold that the family gave you. And I will like to ask that how much of that gold have you all sold? And if it's still in your locker, so that's long term. So I don't see any reason why gold ETF should be treated differently.
Absolutely, I agree with you entirely. But you know what? My only question and my only argument to this whole buying gold for weddings is that so much of the money goes into making charges, into buying physical gold, whereas you could just in a clean and simple manner buy digital gold, right, and cut out all of those expenses. That was my only argument. But I take your point entirely. When you buy gold, whether it's physical or digital, the plan is never to have to sell it, right? Unless there are some really unforeseen circumstances. Lakshmi, am I right? I don't think you must have sold any of your wedding jewelry.
I'm the very typical Kerala South Indian Sonia who hardly had any gold, and you barely see me wearing any jewelry. So I am, as I said, my mom has very, very different views from what I have. With great difficulty, I have actually converted her into a gold ETF investor. I think that was the biggest high point of my investment career, I must say. Everything else just kind of, because the lady who buys gold even for Akshay Tritiya, which is the physical form, if you can convert her, I think that is, conquering Mount Everest for me.
Absolutely. I take that point, It took me years and years to get my parents into the equity markets, into mutual funds, despite me being in the industry for so long. So I take your point. It's like moving mountains to convince parents to, change their age-old thinking. But I guess that's what we're here for. Manish and Lakshmi, thank you so much for joining us. It was very helpful to understand why gold should be an important hedge in your portfolio. But not just that, the better way to approach gold is to buy gold ETFs because it's safe, it's simple, it's easy to buy online, it's easy to store as well. You don't have, it's not cumbersome to store the gold in its physical form, and you can enjoy all the benefits too. As always, a great session on Investmentor. Thank you to all our viewers for listening in, and keep writing to us for feedback. Thanks for watching Investmentor, presented to you by Kotak Mahindra Mutual Fund in association with Network 18.
Kotak Mutual Fund presents Investmentor in association with Network 18.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Focus, ideate, innovate, enable.